Let me give you a little background. I've been in what you might call an insider in monetary operations for 40 years now. I started in banking in 1973. I grew up on the money desk at Bankers Trust in the 70s, back when that was the main dealer operation. I've been trading money, you might say, for a long time. I visit the Fed regularly. What I tell you is known by all the senior staffers at the Fed, Treasury. It is not known by the political appointees, the headline members that you'll see at the Federal Open Market Committee and Treasury Secretary, people at that level. The political appointees are the ones that don't understand that the operations people understand everything here implicitly. Also, today I would say it's also implicitly understood by trading desks, including Goldman Sachs, Morgan Stanley, Nomura, JP Morgan, Credit Suisse. These are all people I've grown up with over the years, and they understand this and know that this is how it works. The last thing I want to say is it's not difficult. If there's anything that appears to be difficult, put your hand up and ask it later. We'll sort it out for you. It's a very simple operation. Now I'm going to give you, we've simplified the title here to why we have deficits. I'm going to give you one thing to begin thinking about. If you've got $1 in your pocket, where did it come from? So your first hint is it's signed by the Treasury Secretary. Okay? Unless it's counterfeit, it came from the government. And they've spent it, and they haven't taxed it yet. So what do we call spending without taxing? It's called the deficit. And part of the government deficit winds up as cash in circulation. Okay? If the government doesn't spend more than it taxes, if it doesn't give you more money than it takes away, you're not going to have it. Okay, so what is casually called the money supply, or part of the money supply, comes from deficit spending. So move right along here. Okay, so what is the monetary system? Okay. The monetary system is nothing more than a scorekeeping system. The Federal Reserve is a scorekeeper for the dollar. Okay. It spends by changing numbers up in our bank accounts, and it taxes by changing numbers down in our bank accounts. Keep up with my order here. The Fed doesn't have any dollars or not have any dollars. Now, let me give you something to think about here. Suppose you went in to pay your federal taxes with some old $20 bills. You went to the Fed, you gave them a stack of $20 bills. They would give you a receipt, thank you very much for paying for Social Security and Afghanistan. And then they throw them in the shredder. And you can buy shredded money in Washington. Okay, there's something different going on when somebody takes your money and shreds it. Okay, clearly they don't need that money to spend. If the banks want $20 bills, they'll give them 20s off the new pile. They don't need your old 20s with germs on them and everything else. They throw those away. If you pay me with $20 bills, I'm not going to throw them away. The state of New York's not going to throw them away. Columbia's not going to throw them away. The Federal Reserve is. Okay, something very different going on there. So let me get a little more specific about how the government actually makes a payment. Let's say it's the beginning of the month and I'm waiting for my Social Security check. So I look up at my computer screen and I see 4,000. That's the balance of my account, 4000. I wait and I wait, and all of a sudden, blip, the 4 changes into a 5. What happened? I just got paid. I now have $5,000 in my account. What did they do at the Fed? What did the person do spending the money? He credited my account. He changed the number from a 4 into a 5. He did not take a gold coin and hammer it into his computer. He did not take somebody's tax money and run over to the next room and push it into the wire. He just changed the number up in my account. All federal spending is simply changing numbers up in our bank accounts. The Fed is the scorekeeper. Okay. If we're at a card game and I'm the scorekeeper, how many points do I have? I don't have any points. Well, if you have a hand and you get 100 points and I give you 100, where did they come from? They don't come from anywhere. I just changed the number in your account. Okay. Now let's get back to taxes again. We know what happens if you pay your taxes with cash, they just throw it away. Okay. Well, what happens if you pay by check? They change the number down in your bank account. Okay. They don't get anything. There's no gold coin that drops into a bucket. Okay. They don't take this and do something, and they just change the number down. So if I have $5,000 in my account, and I pay a tax of $2,000. They just change the 5 into a 3. Oh, and now what happens if, like, one person makes a payment to another person? You write a check to pay somebody else. Okay? The Federal Reserve will change the number down in your account, and they'll change the number up in the other person's account. Okay? Totally separate operations. They're the scorekeeper for the dollar. They don't have any dollars. They don't not have any dollars. Okay, so as I say here, the monetary system is best thought of as a simple spreadsheet. And in fact, it only takes a couple of $1,000s worth of software to run the whole Fed. All you need is like to get one big giant Excel spreadsheet, put everybody on it, and you're done. Okay? The Fed is tasked to make the debits and the credits as legally instructed. And we're going to get to why we have deficits. That's what we're getting at here. How banks create deposits and reserves. In the banking system, loans create deposits. That's how you say it. Loans create deposits. What does that mean? It means if I go in to buy a house, you're just trying to sell your house for, we're in New York, right? Better raise the price. $2.5 million. I usually say $250,000. You go to sell your house for $2.5 million, and I want to borrow the money from a bank to buy it, so I'm going to borrow $2.5 million. My credit's pretty good. So what does the bank do? The bank grants me the loan. They approve the loan for $2.5 million, and what they do is they put $2.5 million into my account, which immediately goes into your account. I don't get to do anything with it except buy your house. Okay, so the $2.5 million loan is an asset for the bank. An asset is something the bank has, something it owns. They make a loan, I sign, I promise to pay it back. They have my promise to pay money. That's worth something. That's an asset. Okay. And they put $2.5 million in an account, in a checking account. That's a liability, which means the bank's promises to pay that money or to pay that money. Okay. Notice the loan created the deposit. They did not go to the Federal Reserve. They did not go anywhere. The Federal Reserve doesn't even know they did this. The $2.5 million, then you sold your house to me, it goes into your account, and let's say we're all at the same bank. So now the bank has a loan from me. I owe the bank $2.5 million, and there's $2.5 million in your account. You just sold me your house. You've got the money, I've got the house, the bank has a mortgage. Nobody has gone anywhere near the Federal Reserve. The money was created, that deposit was created as a matter of accounting out of thin air. The system's in balance. You have $2.5 million in your savings. My savings is negative. I have a loan, I owe $2.5 million. Your savings went up, mine went down. The net is zero, that's how they say it. $2.5 million loan, $2.5 million deposit. Now notice the bank created the money, the deposit, but it's not the bank's deposit. It belongs to you. You sold the house. You get to spend it, not the bank. The bank doesn't just take this and go spend it or anything like that. Okay? And one more thing happens, which is important to understand the sequence. If the Federal Reserve requires the bank to hold reserves, and reserves are just checking accounts at the Fed. So if I can call reserves checking accounts at the Fed from now on for this discussion, is that okay? Okay. So if the Fed requires that you have a checking account at the Fed, your bank has a checking account for, and they use 10% because the math is easy. The real number is less than 1%. So we'll say 10%. And I'm supposed to have there's a requirement that I take that $2.5 million, I keep $250,000 at the Fed. As soon as I give you that deposit, my Fed account is now short $250,000. I'm supposed to have it there, but I don't. Okay? What I have is an overdraft at the Fed. My account is lower than it's supposed to be. It's like if you have a minimum balance requirement at your bank and you don't have it, it's below your minimum. Okay? And so what that is it's technically called an overdraft loan from the Fed. You don't have, the bank doesn't put that money up. That bank owes the Fed that money. It's an automatic overdraft loan. So what we have in banking, this is how it works, loans create deposits, and they also create any reserves that the Fed might require, In the first instance, there's simply an overdraft in your Fed account. You're short what you're supposed to have in your Fed account. Okay. Now, the traditional textbook says the Fed gives you money, you make loans, you decide, and it gives you this money multiplier. That is absolutely correct for what's called a fixed exchange rate system, which has been gone since 1934, so I'm not even going to talk about it. What we've had for our lifetimes is a system where the loans create the deposits and they create the reserves. And the old fractional reserve banking is perfectly correct. It's just for a different system. They still have it in Hong Kong, and they still have it in a couple of other places, but we don't have it here, and none of the other major countries have it. Okay. It all nets to zero. Deposits are necessarily equal to loans. If you've got $100 in a deposit, it's because somebody else borrowed the $100, or you wouldn't have it. There's nowhere else it can come from. And I'm getting to why we have deficits, by the way. But you need to know this. Okay, and the reserves are overdrafts. Okay. So as a matter of accounting, the way they say it is assets equal liabilities, loans equal deposits. They have to because they come from the same place. If they don't, somebody at the bank has to stay late and figure out why his numbers don't add up. And they will find it, usually, within a few dollars. Okay. And the other way it's said is that liabilities are the accounting record of assets. If you make a loan, the record of that is the deposit. It's the accounting record. It has to add up. Okay. Notice there are no net financial assets when this happens. Well, there are no what we call net financial assets. You can't have everybody with savings. Where would it come from? Savings has to come from somebody else's loan, which is negative savings. You owe that money. So everybody can't have $100,000. Somebody has to be, if somebody's plus 100,000, somebody has to be minus 100,000 in monetary terms. It can't come from anywhere else. It's called, the textbooks used to call it a case of inside money. The Italians called it giros, in the 12th century. Debits, credits, one comes from the other. It has to net to zero. Okay, so the only way we could have any net savings, where everybody could have some savings, or the savings could be higher than the loans, is if they came from outside the economy. It has to come from the outside. We can't generate it inside. If you want to save, if somebody gives you money and you want to save it, he would have had to have borrowed it. It has to lower his savings. It can only be transferred around. Net has to come from the outside, and that is the government sector. Okay? And that happens when the government spends more than it taxes. So we have the economy where loans create deposits, one person's savings is another person's loan. The only net savings, the only net dollars, the only net financial assets, all the same thing, can come from the government sector. Now when I talk about the economy, I'm including residents and non-residents. You can live anywhere in the world. We can separate it out where people in New York could be saving, and people in Connecticut could be borrowing, and people in Germany could be saving dollars, and people in France could be borrowing dollars. The whole economy outside of government. Okay. So, we're going to give an example here of how that works. If the government were to spend $1 billion and not tax it, it does it by crediting somebody's account. It changes a number up. Now the system has $1 billion more than it had before. It's really that simple. And the way we say it is total net financial assets of the non-government sector are $1 billion higher than otherwise. Okay? And there's an accounting identity for that. It's called the government deficit equals the non-government surplus to the penny. The government deficit equals the savings in the economy of dollars to the penny. So last year, this year, the government deficit is $1.2 trillion. It spent $1.2 trillion more than it taxed. It added $1.2 trillion more to our accounts than it subtracted. When it spends, it adds. When it taxes, it subtracts. Our savings, the whole economy, worldwide, global dollars, went up by exactly $1.2 trillion to the penny. Or somebody in the general accounting office has to stay late and find his mistake. Because when they change the numbers up, and all the accounts in the world, they have to all add up to the 1.2 trillion, to the government deficit. So why does this matter? Okay. It matters because, in general, the economy has a very strong desire to net save. Why do we have this strong desire to save? It's built into the institutional structure. It's built into the legal structure. We have requirements that will say 15% of your paycheck gets taken away. You never get to spend it. It goes into your pension fund. Okay? We say if you put money in your IRA, you can do that and not pay taxes on it until you take it out. It's a very powerful incentive not to spend your income, to save. And it may not be your savings that you have immediate control, but your business is doing it for you. We have very strong incentives for our corporations to keep very high cash savings. Apple has over $100 billion in their account. Okay, and I list some of them here: pension fund contributions, earnings that our pension funds earn, corporate reserves, IRAs, and all the other savings vehicles, all the cash in circulation, right? And foreign central banks save tremendously. We have central banks, foreign banks with $1–2 trillion sitting in their savings accounts at the Federal Reserve. Those are called Treasury securities. Treasury securities are just savings accounts at the Federal Reserve, nothing you need to worry about. So we've got all these reasons not to spend into all this institutionally driven desire to net save. Well, how can that happen? We can't possibly borrow enough buying houses and borrow enough buying cars and go into debt enough personally to fill up our pension funds. And so what I'm telling you is, and here's a number here, it's no coincidence that the federal deficit is something like $15 trillion, and there's something like $15 trillion in our pension funds. It's like, where else is it going to come from? Now, this is not to the penny. We could borrow some or not borrow. It changes in different years. But this huge number of 15, maybe be closer to 20 trillion now with the stock market, with a 15 trillion plus in pension funds, has to be, that's a savings, it has to represent somebody else borrowing, spending more than their income, or else it isn't going to be there. Okay, so we've created the need for the government to spend more than its income by establishing all this institutional structure that establishes all these pension funds, automatic contributions, money being taken out of our income and put away. It can't come from anywhere else. Think of it as 16 trillion $1 bills. Where would it come from? The government has to spend it and not tax it, or it can't get in there. Okay. This little chart shows, and Stephanie will talk more about this, how the government deficit equals the savings. And this is just a U.S. domestic private sector, but the rest of the world is pretty flat year to year. So this is a pretty good indication of how the government deficit equals the amount of our total savings. Okay. The other interesting thing is what happens when the government deficit gets very low. We can't save. We have to go into debt to fund our pension funds, or else it doesn't happen. And we can only go into debt so far before our credit is ruined and the whole thing collapses. When that happens, unemployment checks go up, tax receipts go down, and the deficit goes up automatically, and now we can fund our pension funds again because there's a deficit. So just a little bit of history here. We've had only 7 periods of budget surpluses. Now, what is a budget surplus? Well, that's when the government taxes more than it spends. It's changing our numbers down more than it's changing them up. It's draining our savings. The same way a deficit adds to savings, surplus takes away our savings. That's just the language we use. We've had 7 periods of budget surpluses, and each one was followed by our only 7 depressions in U.S. history. And I call this last one a depression because unemployment went up over 10%. That was the old definition of a depression. Excuse me. So, in what you can see in the late years of the 90s, unfortunately, the surplus was spun politically as the reason for the good years. It wasn't. It was the reason the good years ended. By allowing the budget to go into surplus, all our savings was drained. Based on where a normal deficit would be, we lost on the ground on maybe $1 trillion worth of savings. It was all taken out. Private sector was going into debt at 7% of GDP, completely unsustainable, and then it all crashed when the next president took over. Unfortunately, the politicians spun it as, oh, the surplus caused the good years. No. The good years, the expansion, because of our tax structure, caused taxes to go up because people were making more money with capital gains and income. Taxes to go up faster than even our government could spend money. And we ran a surplus, drained all the money out of the economy, and it collapsed. The good years caused it, and the tax structure caused a surplus, which ended the good years. It's happened every time. When the surplus ended in 2001, Bloomberg announced this was the longest surplus since 1927 to 1930. Do those dates ring a bell for anybody? Yes. That was our last Great Depression. And we're still fighting. And of course, all our politicians think the deficit is too large, when in fact it's too small. Okay. So, where do all the dollar savings come from? Some other agent spending more than his income. How do you do that? You borrow to buy a house like I did. When older people sell their homes to younger people, the younger people take out mortgages, they borrow the money, they fund the older people's savings. Loans create the deposits. Okay? But we all tend to be net savers. We want to have money in our pension funds. We want to save. And our ability to borrow to do that is limited by income, and it's just impractical. The tax advantages for saving are so strong, they're much stronger than our ability to borrow. Okay? The remaining source of this desired savings is government deficit spending. There's no other place it can come from. And it's no coincidence that the 15 trillion government securities is roughly equal to 15 trillion pension funds. So what's the right size for the government deficit? The right size precisely accommodates the desire to save. Are we ever going to hit exactly the right size? No. Okay. But that would be the right size if we got that exactly right. If we run a deficit that's too large, spend too much and tax too little, okay, we're trying to provide more savings than the economy wants, what happens? All that extra spending drives up prices. It drives unemployment down. Unemployment might go down to 3%, but prices would start going up maybe 10% a month. And we call that monetary inflation. That's inflation that comes from too much spending. That's what happens if the deficit's too large. Okay. Today's deficit is too small. Okay. This is evidenced. Let's see how. I think I said it right the first time here. Okay, by an economy not spending enough to keep everyone willing and able to work, employed, and producing real output. It's a spending shortfall. This happens, the deficit's too small, the government's, for the size government we have, we're taxing too much, we're taking away too much money, too many dollars, and there's not enough left to keep spending high enough to keep everybody employed. Okay, employment is a function of sales and spending. A restaurant doesn't lay anybody off when it's full, it's when it's empty. An engineering firm doesn't lay anybody off when it's full, when it has no orders. Capitalism is driven by sales. Okay, so anyway, we call this the global economy of 2012. Today, the deficit is far too low, given global savings desires.